You look at some of the numbers banding about the possibility that the sum total of the next stage of the government's bank bailout nation could be $2 trillion, which I might add is twice the $1 trillion stimulus package, which I might add is not going to stimulate anything except gigantic deficits and a terrible debt problem and a collapse in the U.S. dollar. So you look at that whole thing, you see, here, Jack Gage, there are some decent fundamentals developing that make me optimistic, Absolutely. And I think you too. But this government story is just hanging over it and could be a disaster. I mean, in some sense, why don't they just let the Federal Reserve do what the Fed is doing? Because that's been working out pretty well.
Absolutely. The Fed is responsible thus far for driving down 30-year fixed mortgage rates by buying long-term treasuries. So this is something that they're doing positively. But listen, I'm for anything that delays the stimulus going forward.
Delays the stimulus.
Abolish the stimulus as far as I'm concerned. It's not a stimulus bill, it's a spending bill. And I think, listen, there are some encouraging signs. Existing home sales beginning to rebound. That's good news. Mutual fund inflows have rebounded in 2009. They're up 3 weeks in a row. So this is something we're starting to see people move back into the market. Cheap valuations on the debt side and the stock side are both very compelling right now.
All right, so Stephen Abrams, look, we had some charts up on the full screen. Maybe we'll put them up again. One of them is the 2-year swap spread relative to the stock market. The swap spread has collapsed. The rising blue line is an inversion of the 2-year swap spread as a measure of fear in the credit market. And I think the Federal Reserve has done a lot of good on this. That thing is showing the possibility of a huge stock market rally because they generally move together. The money supply is growing rapidly, Stephan. We are seeing a bottom in commodities. We've seen a bottom in energy, which means we get the big energy tax cut, but the deflation and recession there may be over.
Risk is gone.
Stephan, I think that there's a tremendous market rally despite this uncertainty over the bad bank.
Well, Larry, there is. I happen to agree with you.
You do? You buy this?
Well, we've been putting a little money to work in the equity market. Let me make the point that nobody rings a bell at the inflection point, either at tops or at bottoms. But you're quite right. There are a whole series of market-based early cycle indicators that are very noisy on a daily or even weekly basis. But if you look back for the last 2 to 3 months, they've all bottomed, and they're all heading higher. And tomorrow we're going to get a horrendous fourth quarter GDP figure, but that's ancient history, and the likelihood is that even though the first quarter is starting off on a sour note, it will not show anywhere near the rate of decline that we see in the fourth quarter. As the market begins to see a decline in the rate of decline, the rally is going to take off.
Would you buy deep cyclicals right now? That's the big question. Industrials, commodities, maybe some energy, maybe some technology, maybe some consumer cyclicals. Would you buy them on the strength of these forward-looking market indicators, which we have had on the screen for a couple of nights now? Would you buy deep cyclicals? That's the question.
Well, some of them aren't as deep as you're implying, but the answer is you should buy those because they are the most depressed. They are the early cycle responders. And global industrialization and global infrastructure building will soon reassert itself and will remain for some years the dominant investment theme.
By the way, one of the important market indicators
how are they going to do that?
Is a stabilization.
How are they going to do that when the lending is slowing down? Lending is already slowing down at the banks. Foreclosures are accelerating, layoffs are accelerating, and we aren't putting more, despite what the spreads say, private money isn't getting back into the system. I don't see any bottom here, and furthermore, markets bottom when you start finding leadership. This market has no leadership at all.
Jack,
education and healthcare, and the rest is gone.
Lacamp is running, he's hiding, he doesn't buy any of this optimism. What's your take on Lacamp's story?
I think it's absolutely wrong. I think it's only looking at one side of the coin. Look at the spread between 10 years and tips, okay? The price expectation going forward is not for a deflationary environment. I think that's a positive. That's been the major risk thus far. Fed came out this week, very pro-inflation stance. I think that is good news that deflation is no longer a risk.
The Fed is going to be the ultimate savior.
Absolutely.
Not TARP, it's the Fed.
But real interest rates aren't helping.
Listen,
Look,
deep cyclicals are a very good place to be right now. It's time to put money into this market. Over the past 100 years, stocks have returned 8%. Over the next 20, they will as well.
Yeah, what do you think about that,
For the
Lacamp,
last
on
10,
the way
they're
out?
negative.
Huh?
For the last 10 years, stocks are negative. Everybody forgets that from 68 to 82, we had a horrible market. From 29 to 45, we had a horrible market. And unfortunately, I hate to say it, but this market looks a lot more like those markets than any of the markets we saw from 82 to 99.
I will just continue to say that the mustard seeds of low inflation, energy tax cuts, the commodity deflation is bottoming out, energy is bottoming out, the worst of this is over, and those market indicators are signaling a big rally ahead. I'm sorry, Jim Lacamp, we will agree to disagree.
Don't forget runaway
Much
government spending.
More
Run away.
to be revealed. Thank you, Stephen Abrams and Mr. Lacamp and Jack Gage.